how to simulate stock, but that was just one stock. And then what if our derivative, the underlying number of underlying asset of our derivative is, what if it is more than 2? What if we have more than 2 underlying assets? Okay, then we have to simulate maybe 2 stock returns, for example, right? So suppose, let me think of an example about this one. Suppose, okay, we wrote down a derivative. The underlying asset is like Google and Facebook. Okay, suppose Google and Facebook. And then it is derivative such that at the end of the, at the expiration date, you have option to pick the better one, or maybe none of them. So the structural thing is that if the, so you can choose one of the 3, like you can pick Google, you can pick Facebook, or nothing. If you pick nothing, then you don't have to pay nothing, and then you may receive some fixed amount of money, for example. Then this kind of a derivative looks very good, right? If Facebook performance of Facebook is very good, you can simply select Facebook. Okay, I'll pick this one, and you will receive Facebook stock. And if Google is good, maybe you can pick Google, and they will give you Google stock. And none of them is good, and you don't pick anyone, and you simply receive a fixed amount of money, right? That looks pretty good, right? And the question is then, what should be the price of that? What should be the price of that contract? Okay. Again, idea is very simple. The idea is such that we can simulate Facebook stock return and Google stock return in the risk-neutral world. Okay. First, we have to assume that we are living in risk-neutral world, and we simulate Facebook stock return, Google stock return, and then at the end of the day, at the expiration, that we have a lot of scenarios for the possible value of Google stock return and Facebook stock return, and we have a possible payoff. Okay, then we can get the average of them, and then we can discount it back with risk-free rate. Then that should be the price. Right? Again, as always. As always, the principle is the same. Okay, whatever derivative we have, whatever asset we have, our valuation is always the same. The value of asset today is always discounted with risk-free rate, and they get the expected value. Get the expected value VT. Okay, we simulate VT value of an asset at time t, and they get the average discounted back. Good important point is that we have to simulate this one at the risk-neutral world, in which everyone is risk-neutral. So asset return of everything should be risk-free. Okay, so let's do that. You can open your Excel file as well. Again, save it. Macro, and then okay, we set it up, and then let's pick 2 stock. Let's pick an interesting one. First, let's pick an Apple. Okay, Apple, and then let's download last 5 years, historical prices. Okay, last 1 year, historical price of the Excel. And then let's choose another asset, which is Apple. So what else? So do we have any other interesting? Something like Microsoft now. Microsoft. So in this case, we write down a derivative such that we can pick so either return from Microsoft or return from Apple or nothing. Okay. So this is Microsoft. I need only this one. Microsoft. This is MSFT, AAPL, and I don't need this part. Okay, and then let's find the return for this one. Just in case, let me save this file. Okay, so return is, let's say, log. Let me use a log return. Okay, so they are the returns for Apple and Microsoft. And then let's say average return first. Average daily return. Which is huge, as you know. Apple's performance was very good. So average daily return is this one. So annualized return is we multiply this one with multiply the 252. So 45%, huge. And then daily standard deviation. Apple, which is this one. So annualized volatility, annualized. So volatility is just annualized one. So this one multiplied by 5, and then okay, done. So actually, Apple's, Microsoft, both of them were very good. Apple's annualized return is 45% huge, and Microsoft is also huge, 30% annualized return. Wow, amazing. No wonder they are, in terms of market value, #1 and #2 companies in the world. And Apple's market value is even greater than Russia's entire stock market value. Look, they are fantastic stocks. So suppose now, let's assume that you are an investment banker in the Goldman Sachs, you guys, and then you go to client and you want to sell a product that, okay, please invest to Goldman Sachs in such a product. If you invest in this product, okay, it is like investing the best of the best. Okay, you know Google is best, no, Apple is best and Microsoft is best. And the good thing is that after 2 years, you will pick the best of those two ones. Okay, so it is very good. And in addition, just in case both of them underperform market, in that case, I'll give you original $1 to you. Okay, that's pretty excellent. And the question is, how much you have to ask your client to invest in your product. So the structure of the product you are selling to your client, then you have like option to invest $1. You invest $1 in Apple, invest $1 in Microsoft, and at the end you can return $1 back. Okay? Do you know what I'm saying? Do you know the structure of the product? Then what should be the price of that contract if you offer this kind of investment opportunity to the client? Okay, since we know volatility and let's say risk-free rate, let's say risk-free rate is, I don't know, let's say risk-free rate is 1%. Then it is simple. What you can do is, okay, based on, anyway, we are in the risk-neutral world. So regardless of the past fantastic returns from Apple and Microsoft, in the next 1 year, we have to set expected return of the Apple and Microsoft just 1%. And then we use the same annual volatilities and we generate stock return, and then we calculate max of Apple or max of Apple, Microsoft at $1, and that should be the one. Okay. But the question is that possibly the stock return of Apple and Microsoft are correlated. If it is not correlated, our problem is simple, right? We can simulate as we simulated before. But the question is how we can do the simulation if the stock returns are correlated with each other. If it is not correlated, what we can do is, okay, let's see, simulation. What we can do is very simple. Okay, we can simply simulate two random variables from standard normal distribution. So random 1, random 2. Okay, so 1. Let's simulate the 14 number. So norms inverse and okay, if there is no correlation, okay, what we can do, we can just two random numbers and simulate two returns, AAPL, MSFT, and then let's say this is the, let's call this is the time to maturity. Let's say time to maturity is like 2 years, okay? And then let's call this one as the, the time to maturity. So interesting. This is already nice name, time to maturity. And let's say this one name as the risk-free rate. Good, okay? Let's call this one as the volatility and 1. And let's call this one as the volatility 2. Okay. Then this one is, of course, this one is Apple's stock return. Okay. So if you invest $1, what you can do is, okay, because, okay, I'm thinking about everything in terms of $1. So ST is S0 multiplied ER T plus sigma T epsilon, right? Right? So if I invest $1, then I can simply divide each side as 0. And if I invest $1, at the end, I will get this amount, right? So let me calculate this one. Do you know what I'm saying? So I can divide this one with today's stock price. So if I invest $1, my holding period return at the end should be this one. So if we invest $1 in Apple, what you get at the end is expected return and risk-free rate. Your risk-free rate minus volatility 1, volatility 1 square divided by 2 multiplied by multiplied by T time to maturity, and then plus volatility 1 again, volatility 1 multiplied by time to maturity to the power of 0.5 multiplied by this one. I think this is right. Okay. So this is one simulation. So this is apparently not good, but yes. So if we invest $1 in Apple, we did a 14 simulation, and what you will get at the end is this amount. In the risk neutral world, not real world, right? Important part is this risk neutral world. And if you invest $1 in Microsoft, when you get L, this should be M first, and then this should be 2, volatility 2. Okay. So value of derivative. So your investment opportunity will have a max of this one, and your 원금 $1, original $1. Okay, you can get your $1 back. Something like that. So in this case, if you invest $1 in Apple, you will get just $0.9. So both of them are pretty good stock, but this is so unfortunate case that in this case you lose money. In that case, you get your original money back. Okay, so you have $1. So this is value of derivative, and then at the expiration day, so what is your value of derivative today is then it's simple. You can get the average of this one, and then discount it back. Risk-free rate multiplied by time to maturity. Okay, so this is some kind of value of derivative today. No, it means that when you give this investment opportunity to your client, you have to ask, okay, so if you invest $1, you will never lose money, right? Because in worst case, you can get your $1 back. So when you offer this investment opportunity to your client, the client should pay you 10% of premium. Okay, something like that. Of course, since you want to make more money, so maybe you want to sell your client at more than this one, definitely, in order to make money. So this is the kind of what sales people in the investment bank do for capital market division. So anyway, but so this is the idea we used last week. But the question is, problem is that I assume that this random number and this random are independent of each other. But it is likely that Apple and Microsoft stock return are likely to be correlated with each other, right? So when one is good, the other is likely to be good. When one is bad, the other is also likely to be bad, right? Let's check the correlation between them. So let's check correlation between them. Correlation between Apple and then Microsoft. Right? The correlation is 20%. 20%. So correlation 20%. I don't know whether it's significant or not, but it's likely to be significant. Let's check the graph of this one. Okay, let's check the graph of this one. Let's check graph of this one. No, this one is no. Okay, let's make it simple. Okay. Okay. So the first one is Apple and second one is Microsoft. You see, they are correlated with each other. When one is good, the other one is also good. When one is bad, the other is also bad. So they are clearly correlated with each other. They are not independent of each other. So that's why, so it has a great implication for your product because it adds risk to your product, right? So in given the structure of your derivative, you give max of this one and this one and this one. So if they are independent of each other, when one is good, the other is likely to be bad, but it is likely when one is bad, the other one is, it is very high chance that the other one is good, so you can pick that one, right? But when they are correlated, then they are moved together, so the value of your derivative should be lower, right, in that case. Then how we can incorporate this correlation structure? Okay, that's the question, right? In order to incorporate correlation in the structure, okay, there is a technique, and I think I have the link for this one in our course web page. Okay. Okay. Generating two sequences of correlated random numbers. Okay. Generating two sequences of random number with a given correlation is done in two simple steps. First, generate two sequences of uncorrelated normal distributed random number x1, x2, and then define new sequence as this one. Okay. Then it becomes such that x1, the new y1 will sequence will have a correlation of rho with x1. So correlation, if you define new random variable y1 in this way, then x1 and y1's correlation is what? Rho. In this case, 어디? in this case 18%. Okay, so let's do that. Okay, so now it is simple. So let's generate random 0 such that it is norms inverse and length. Okay, this one. Okay, so this is random number 1 and random x, let's say, and our new random variable correlated one is what? Let's call this one as low. Okay, I call this one low. Then it should be, okay, we can use exactly this formula. Okay, this one rho multiplied by this one plus 1 minus rho square multiplied by to the power of 0.5 multiplied by this one, right? Okay, we are done. Okay, now this one and this one is correlated, so Apple and Microsoft stock return should be correlated, and I have a new derivative. Okay, apparently I have even higher one than this one, previous this one, but it is I have simulated 14 times only. Okay, today. Okay. So actually, thing is that we can increase the number of simulation now, right? And then let's check the correlation between the two. Okay, let's check indeed the whether correlation is 18%. Correlation between this one and then this one. Okay, interesting. This is not okay. Now this is very similar, right? But you know, I don't have much number of simulations. It's small, so sometimes it's greater than 80% or less than 80%. But anyway, I think if I increase the number of simulations more, it is just 244. Then you should be around exactly. If we have infinite number of simulations, it should be exactly 18%. Okay. So anyway, value of derivative. Value of derivative is the exp minus risk-free rate time to maturity, and then average of value of derivative at the expiration date. Okay, so value of derivative is this one. So do you know what is going on now? The correlation structure is very important, right? So you can develop seemingly very attractive financial product. Pick Google, pick Apple, pick Microsoft, or you can get your money back. Okay? Very attractive.
The simulated correlation, random 1 and random 2?
Oh, the thing is that, okay, I'm just checking this. So, okay, this is random number. They are two independent random variables. And this one, I want to correlate the random numbers, correlated with this one, with correlation is 18%. So this simulation correlation between this one and this one, I want to check whether the correlation is indeed 18%. Okay, see the formula rho m3 1 minus rho square root L3, okay? Something like this. So, of course, it is not exactly 18%. Where is 18%? Not exactly 18%. Not exactly 18% because I have a simulation only around 200 times. If it is 200,000 times, it should be a lot similar to 18%. Okay? Which you can do with a visual basic. So, do you know what is going on? Fairly exciting question. It is simple, right? Yes. It looks fun, easily. You can develop innovative financial products, right? Using this framework. You can develop innovative financial products and get the price of this one, and you know how much you can sell it to your client, right? And then maybe another question, okay, now we can simulate stock return, 2 correlated stock returns, and what if I want to simulate 10 stock? So you want to offer your client that now Apple, Microsoft, Google, Facebook, a bunch of 10 stock, and at the end you can pick just the best one. How can you do that? Then you have to generate 10 correlated stock returns, right? That is actually slightly difficult. For that one, you have to do something called correlative decomposition, actually. This is not hard, but conceptually that's very easy. I will not cover it. We will not do it actually in class, but correlative decomposition means okay, this is code, just code. Correlated random numbers, multivariate normal distance. So this is 2. Okay. In this case, suppose you want to generate a random number with correlated structure like this. So it is a vector. Y is a vector, and then mu is mean of those vectors, and sigma is a variance covariance metric. Do you know what is a variance covariance metric? Right? You know variance covariance. So what if? So if you want to simulate 10 stock, the correlation between them, covariance between them would be look like this one, right? And the question is how we can simulate this one. For simulation, the mu part is easy, right? Mu part is easy because since we simulate everything in the risk-neutral world, expected return is just risk-free rate. Risk-free rate multiplied by time to maturity. And then this part would be a bit hard, but at least you can estimate using the data. From the data, you can calculate variance and covariance between the over stock and between the two. So if you have 10 underlying assets, you have to 10 multiplied by 9. You have to calculate 45. Okay, you have to calculate 45 variance or covariances. So which you can do. So once you did that, the second step is you first need to simulate a vector of uncorrelated Gaussian random variables. So suppose you want to generate 10 random numbers. First thing is you can just 10 uncorrelated random numbers. Okay, that's step 1. Step 2, you find the matrix called C, such that C prime transpose C becomes your variance covariance matrix. Step 3 is simple. Your new correlated stock return is risk-free rate plus the C matrix multiplied by your original uncorrelated 10 random numbers. This C transpose becomes this omega matrix. This C is called, this decomposition is called correlative decomposition. And this correlative decomposition is not hard because computer will do that for you. So simple. If you want to generate like 10 correlated random number, first you can calculate the variance covariance matrix, which you can do with the data. Second, you can do correlative decomposition and get C. Third, you multiply C to your original 10 times series, 10 stock return, and just add the risk-neutral, risk-free rate, then done. And then you can do whatever you want to do. Pretty cool, isn't it? Any questions? So you know what is going on, right? So of course the next step is since you have this one, so next step we want to develop Visual Basic programming for this one, right? And then I think we don't have enough time for developing this Visual Basic today. So let's do it next week. So any question? Yes.
So you already said that because most stocks are correlated, so it was logical, the entire economy is better, then most of the stocks will do better. The people who get those products think they have more choice because they hope that even one is going down, the other might go up, and they always can choose the best.
Yeah.
But is the product also more unfair because we still live in the risk-free world, right? So there's still no arbitrage for us. Do you know what I mean? Because psychologically, your clients might think this product is much better than just getting one stock, which also has one expected return. And then
Yeah.
So
So that's why it is more expensive.
it's not, oh, it is more expensive.
Yes, so the thing is that it depends on how much you sell, at which price you sell to your client. If you sell your product, so your client invests $1 for this product, okay? But when they invest $1, you have to pay additional $0.19 as a fee to you, right? And if you receive more than this one, basically you are making money, but your client is slightly losing money. And if you sell at lower than this one, then you lose money and your client make money. So it depends on how much you sell your product. Right? So in the end, if you sell at this price, everyone is fair. But thing is that maybe client has, although it is fair, but maybe your client has some special preference given his asset portfolio or given his risk preference. Maybe he has special preference for this kind of structure, right? It is possible, okay? Then by offering this product, although it is fair, you can at least increase the utility of your client as well as the utility of you.
We should try to find two anti-cyclical stocks. The one is doing bad, the other one is doing good. We can always choose the best.
Yeah, so it doesn't, that is actually very good idea, but the thing is that it doesn't have to be like anti-cyclical to each other. Maybe they have low correlation. It is good. Maybe one for highly volatile IT stock and another for like a steel maker, right? Things that, or maybe you can offer a derivative based on two market. One investing in $1 in Chinese market and invest $1 in US market. Of course, the Chinese market has been spectacular, attractive, but maybe some people hate to take too much risk in Chinese market. In that case, by offering this product, okay, you in Chinese market, but if Chinese market is bad, then you can get money from US market or your original money back, something like that. So Chinese, of course, the Chinese market and US market are highly correlated with each other nowadays. But
China's owning US.
yes, but thing is that they are good news is that they are not perfectly correlated. They are not perfectly correlated, right? So, so actually there are in Korea, actually in Korean market, there are some products like this one already, and it is sold in the market. Like invest in Chinese market, so like there are a bunch of attractive stocks in Chinese market, and they give you option to choose the best one only, something like that. And then this one is simple. So in the worst case, you can your original money back. But in that product, maybe you can impose a ceiling and floor. So if you invest in 3 assets, and if none of them go below some level, then you can receive this money. And if all of them fall to the certain level, you receive this one, and then one of them go above them this level. Now you receive something like this one, something like this. You can develop a lot complicated semi-objective product. So something like this one is already sold in the market and has been very popular. And in the background, when quant calculate how much they sell to you, they do exactly this kind of analysis.